Assalamu alaikum and hello everyone. In this lecture, we will discuss how to analyze a new project. We will calculate initial investment outlay and the project annual cash flows, and then we evaluate the complete project based on net present value. So we have Fundamentals of Financial Management by Brigham Houston, and we are completing problem 12-8 in this lecture. So here we have this problem. You must evaluate the purchase of a proposed spectrometer for research and development department. The base price is 140,000. So this is the outlay of cash, and it would cost another 30,000 to modify the equipment for the special use by the firm. So this is the initial modification cost. So should be capitalized. That is, it should be the part of the cost of machinery or the equipment. Then the equipment falls into the Masters or MACRS 3 years class and would be sold after 3 years for 60,000. So this 60,000 is the salvage value. The applicable depreciation rates are 33%, 45, 15, and 7%, which is 33 is for first year, 45 is for second year, 15 uh, third year, and 7% is for fourth year. The equipment would require 8,000 increase in the net operating working capital, which is a spare parts inventory. The project would have no effect on revenue, but it should save the firm 50,000 per year in before tax labor costs. So this is 50,000 is basically the savings, and this is before tax. So we will have to calculate after tax value. The firm's tax rate is 40%, and the first requirement is what is the initial outlay at the year 0. So first calculation is initial outlay, or you can say outflow of cash at year 0. So we have the base price of the equipment. Base price of the equipment is $140,000. Then we have equipment, you can say modification cost, or you can say simply modi modification cost, which is we have discussed it is 30,000. So we add this 30,000 because it is the part of the cost, as well as here 8,000 increase in the net operating working capital, which is the spare parts inventory. So net operating working capital is also required. Net operating working capital. So total cash outlay for the new equipment would be, this is 8,000, which is working capital. Now, when we add all these three, we get total initial outlay, which is $178,000. So this is the first requirement. The second requirement is what are the project's annual cash flows at year 1, 2, 3? So project annual cash flows at year 1 year 2, and then year 3. Here, these are annual cash flows. So first of all, we have this saving 50,000, and this is before tax. So after tax, savings are 50,000 into, you can say, 1 minus t. You're going to multiply 1 minus t. T is the tax rate, which is 40%. So the amount is 30,000. So same is all. The amount is same for year 1, year 2, year 3, because this is per year before tax. Then um, there's a depreciation tax saving. So depreciation tax savings. Here we are using Messrs MACRS depreciation. So we use these rates to calculate depreciation. In the year 1, the cost of the asset is total 170. Here you can see the base price and the modification cost. These two are the part of the cost of the asset, which is $170,000. So here we have $170,000. We multiply it with the depreciation rate. First year it is 33%. So we take 33% and then we multiply by the tax rate, which is 40%. So this is the calculation: 33%, 40%, and 170. So this is the amount of depreciation tax saving at year 1. And year 2, the rate of depreciation would be 45. So instead of 33, it is 45%. And the next year, it is 15%. So here it is 15%. So these are the depreciation tax savings. And then we have discussed about the salvage value, that you can check it here. Mm, this one. The equipment falls into the Messrs 3-year class and would be sold after 3 years. So after 3 years, the company will get 30 this salvage value, which is $60,000. Then the company, obviously, this is the company's earnings or inflows, so company will have to pay tax on it. So tax on salvage value on the third year. Obviously, this is on the third year, and the equipment, we have to calculate, first of all, the remaining book value, because we have these depreciation amount is for depreciation as per Messrs rate. Depreciation is for 4 years. So book value is needed to be calculated. Here it is the calculation or supporting calculation. You can see 170,000 into 7%, into 7% here. So which is 11,000 900. This is just like depreciation, tax saving. We have calculated 33% and so on. So the this is the book value. So the difference between the salvage value and the book value. Here you can see this is the book value and the salvage value. Salvage value is 60,000. So the difference between these two is 48. This amount is just like the gain on salvage value or capital gain. So we calculate tax on salvage value. So this is the salvage value, gain on salvage value. So we take 40% of it. So here we have 48100 multiply by 40%. So this is the amount. This is the tax on salvage value. What we did, we deduct the book value from the salvage value, and we got gain on salvage value because book value is less than salvage value. So we got gain, and on this gain we have to pay tax. So that's why we are uh, deducting it from the inflows. So here this amount, actually we have calculated this amount in this way. Then the last thing which is remaining, the return of this spare part inventory, or you can say, because here in initial outlay, the company required 8,000 increase in net operating working capital due to the spare parts inventory. So when on the third year, when company sold this equipment, so the company get back its 8,000 spare part inventory. So return of net working capital, which is 8,000. And this is of obviously the year 3. So here we have the total annual cash flows. These are the total cash flows amount. We are adding all of the amount. So this is requirement number 2. The third requirement is if the WACC is 12%, weighted average cost of capital is 12%, should the spectrometer be purchased? Uh, for this, we need to calculate net present value. So we have one column which represent years, then we have cash flows, then present value factor, then net present value. So at year 0, 1, 2, 3. So at year 0, we have this outflow. You can see this is the outflow. So at year 1, then this is the inflow at year 2, year 1, year 2, and year 3. So here cash flows, outflow means minus 178,000. First year it is 52,440. Third year it is 60,600. Fourth year 88,960. Present value factor is 1 divided by 1 plus I mean interest, rate of interest, which is weighted average cost of capital, which is 0.12 or 12%, and raised to power n. Here in year 0, n is 0. And year 1, n is 1. Year 2, n is 2. And at year 3, n is 3. So these are the factors. Now what we are going to do, we are going to multiply cash flows with the present value factors. So in year 0 we have n8. So n8 multiply by O8. So these are the inflows or present values of inflows each year. And when we add it, we get net present value. So you can see net present value is negative, which is minus 19,549. Company should not purchase this equipment or spectrometer because the net present value of the all cash flows is minus, or it is negative minus 19,549. So company should not purchase this equipment. So that's it from this problem. We have calculated initial outlay, or you can say outflow of the cash at year 0. Then we calculated annual cash flow at year 1, 2, and 3. And then we calculated the present value or net present value of outlays as well as outflows as well as inflows of cash. And the final answer is negative NPV, which means that the company should not accept or the company should not purchase the equipment. So that's it from this lecture. Take care, class.